There's a pattern that shows up before every major market crash. Not a theory, not a prediction, a repeatable sequence that's been executed again and again, quietly, by the wealthiest investors in history. Most people never see it coming, because by the time panic hits the headlines, the smart money has already moved. Here's what almost nobody understands. Market crashes don't happen randomly. They follow a mechanical cycle. Prices stretch beyond reality. Debt piles up. Leverage spreads everywhere. One trigger appears, and suddenly forced selling takes over. That's when fear explodes, and regular investors get wiped out. But the investors who win in these moments don't guess. They follow the same playbook. The same pattern showed up before 1929, before 1987, before 2008, and before 2020. And every single time, a small group of investors positioned themselves before the collapse, while everyone else was still optimistic. What's unsettling is this. The early steps of that same pattern are forming again right now. Cash is piling up. Risk is being quietly reduced. Big players are repositioning, not because they're scared, but because they recognize the sequence. In this video, I'm going to break down what that pattern actually looks like in simple terms. The 3 moves that have historically protected wealth before major crashes, and why seeing them appear again could mean we're much closer to the next major market shift than most people think. But before we look at what to do, you need to understand why this pattern repeats, and why beginners almost always miss it until it's too late. Let's start there.
My name is Mac, and on this channel I try to make investing simple, especially when the headlines are loud and everyone is panicking. And here's the hard truth. Most beginners don't lose money because they picked the wrong stock. They lose money because they get caught in the same emotional trap every cycle. They're fully exposed when the market is fragile, and they have no plan when it cracks. So today, I'm not going to tell you to predict a crash. I'm not going to tell you to go all in or all out. I'm going to give you something better, a clean, step-by-step framework that explains how smart money typically positions before big drawdowns, and how you can protect yourself and stay ready for opportunity. Because the goal isn't just to survive a crash. The goal is to still have money and confidence when the best buying opportunities show up.
Most people think market crashes are random, like lightning. One day everything is fine, then suddenly it's chaos. But in reality, markets usually don't collapse from one bad headline. They collapse when the system becomes overloaded, like a bridge carrying too much weight. The warning signs are usually the same categories. Prices detach from reality, leverage builds up quietly, risk gets normalized, and everyone starts believing the story that this time is different. And here's the important part for beginners. By the time the crash is obvious, it's already expensive, because panic doesn't give you time to think. Panic forces decisions. That's why the best investors don't wait for the breaking news. They reposition while it still feels uncomfortable, while everyone else is still confident. So if you're watching this and thinking, Mac, I'm not a billionaire. I don't have hedge fund tools. Good, because you don't need their tools to copy their logic. You just need to understand what the 3 moves are designed to do. Reduce fragility, protect purchasing power, keep optionality for the moment opportunity appears. Now let's build the full picture.
Here's the simplest way to understand crashes. Crashes are not just the market going down. They're a chain reaction. First, confidence breaks. Then forced selling begins. Then credit tightens. Then the economy slows. Then policymakers respond, usually with rate cuts, liquidity, and stimulus. That's the mechanical sequence. And smart money positions around that sequence. They ask 3 questions. First, if markets drop fast, what keeps me from being forced to sell? Second, if governments respond with stimulus or money creation, what protects my purchasing power? Third, if panic creates discounts, will I have cash and courage to buy? Those 3 questions lead to 3 moves. This isn't about being dramatic. It's about being prepared. Because the best investors don't need the exact date. They just need to see the system getting fragile. Now let's go step by step.
The first move isn't make a killing. It's don't get destroyed. In crash periods, the biggest enemy is forced selling. Forced selling happens when you lose your job, your bills rise, an emergency hits, debt payments choke your cash flow, or you panic because you don't have a buffer. So smart money increases liquidity before panic, not after. As a beginner, this doesn't mean you sell everything and hide. It means you build a buffer that keeps you from making desperate decisions. Think of it like this. If your finances are a house, cash is the foundation and the roof. Without it, one storm forces you to rip the walls apart just to survive. Beginner version of this move: build emergency savings. Reduce high-interest debt. Avoid being fully stretched with zero flexibility. That's how you prevent the market from turning into a personal crisis. Here's the twist most people miss. Cash protects you from a market drop, but it can expose you to a different risk: purchasing power erosion over time. In major crises, policymakers often respond with rate cuts, liquidity programs, and stimulus. That can stabilize markets, but it can also quietly change what safe really means. So smart money often pairs liquidity with protection against purchasing power loss. This isn't about buying a specific asset right now. It's about understanding the role. The role is simple: protect purchasing power when the policy response changes the environment. Beginner version of this move: understand inflation sensitivity. Avoid relying on a single assumption about the future. Build a portfolio that can survive different regimes. Because protection isn't only about avoiding losses, it's also about avoiding silent loss. This brings us to the most misunderstood move of all. In calm markets, protection feels unnecessary, like paying for insurance on a house that isn't on fire. But when panic hits, protection becomes expensive or psychologically impossible because fear spikes. So smart money thinks about downside protection before stress shows up. Hedge funds use complex tools. Beginners don't need to copy that. The lesson is the principle. You want optionality. You want a plan that doesn't require perfect timing. Optionality means if markets drop, you're not trapped. If markets rebound, you can still participate. And if panic creates discounts, you can act. Beginner version of this move: keep a disciplined allocation. Rebalance instead of react. Avoid all risk, no defense portfolios. Decide in advance what you'll do at -10, -20, and -30%. Because crashes don't destroy most people's wealth. Their lack of a plan does. And after the crash, when great assets go on sale, that's where long-term fortunes are built. But you only get to participate if you did the first 3 moves correctly. You had liquidity, you protected purchasing power, and you stayed psychologically stable. Which brings us to the biggest reason beginners still lose.
Most beginners don't fail because they're stupid. They fail because their entire plan is built on hope. They hope they'll sell in time. They hope they'll buy the bottom. They hope they'll stay calm when things get ugly. They hope they'll figure it out later. But crashes don't test your intelligence. They test your emotional wiring. And this is where everything breaks. The first mistake is building a portfolio with all offense and no defense. A setup designed only for good times will always collapse in bad times. When conditions change, there's nothing to absorb the shock, and every move feels urgent. The second mistake is treating normal volatility like a personal emergency. A down week isn't a life event. A red month isn't a crisis. But beginners experience every dip as if something is fundamentally wrong. And that emotional overreaction is what turns temporary losses into permanent ones. The third mistake is waiting for certainty. People tell themselves they'll act once things are clear, once the data confirms it, once the headlines feel safe. But certainty only shows up after the market has already moved. That's why people consistently buy late, sell late, and stay trapped in the same cycle. Here's the reality most people never accept. The real edge isn't predicting the crash. It's building a structure that makes you hard to break. And once you understand that, everything shifts. Now let's turn this into a simple plan you can actually follow.
Here's your simple crash-ready plan, without trying to be a billionaire. Make sure your life can survive volatility. That means an emergency fund, controlled debt, and a budget that isn't balanced on a knife's edge. Stop building a portfolio that assumes one perfect future. Diversification isn't boring. It's what keeps you in the game when reality doesn't cooperate. Decide your rules before the next red week. What do you do at -10%, -20, -30? And what changes if your income changes? Build a buy list now, not during panic. High-quality companies, simple index exposure, and assets you'd be comfortable owning for years. Because when fear hits maximum, thinking gets expensive. If you do this right, when the next drawdown comes, you won't be asking, should I sell everything? You'll be asking, where are the discounts? and how do I buy safely? If you want, in the next video, I can break down a beginner-friendly checklist for building a buy list and a rebalancing plan that works even when the market is ugly. Subscribe, and I'll see you in the next one.